Nice to see you all. Thank you very much.
Not
I
at all.
just thought, actually, I'm going to switch the share back on again, just very briefly, because I thought I just want to show this chart. This is a chart going back to October 17, and it is the purple line is the average discount, the median discount, sorry, on the all funds. The quoted data kind of purpley, pinky red thing is equity funds, and the blue one is what's been going on with discounts on alternative income funds. So I think that just illustrates the story with what we're dealing with here. We had the big sort of sell off around COVID time, and obviously that bounced back again quite slowly. But then we had a slow deterioration as interest rates started to be talked about, and then a much more savage sell off. And then, although we had this recovery when thought we interest rates had peaked in October, that's come back again since. Anyway, so that just to set the scene. There we go. So, good morning, all. Thank you very much for doing this.
Not
Um,
at all.
I think we'd start with just talking about what we think the causes of the discount widening have been. And maybe can I talk to Ben first? And if you think about the sort of general big picture, um, are there any factors that you can pull out that you think are responsible for this?
Well, I think the main thing has really been the rise in interest rates. I think that's probably been the biggest issue that we face. And I think particularly when I'm thinking about the equity income space, a competitive yield from cash of 5% or so has really drawn investor attention, and has become quite a viable competitor, I guess, to your classic equity income fund. And one of the I guess positive angles would have been around the fact that we can offer a significant yield premium to cash, and that no longer exists. Now, of course, that ignores the arguments about it being a real return, that there are capital returns, that there are much better total returns that all come through. But I think in that there's clearly a piece of the market which is looking for income, particularly in sort of retirement drawdown. And I think that the aspect of looking to put that in cash has really been probably the single biggest impact. And the average discounts move out, 5-6 percentage points, and for Dunedin, the trust that I co-manage, that's moved out by nearly 10 percentage points. There are probably some specific other aspects to that which we can touch on, but I think it's in that big increase in cash rates that's really been the change for me.
Yeah, I think I agree with you. That's the sort of the prime cause that I wrote down too. But there are other things going on as well. But maybe Nick, do you want to sort of talk to what you think the impact of cost disclosures might be?
Well, it's the biggest pushback when we're out marketing MyGo, is that advisors, if they've got an investment trust in a model, they have to add those costs or the underlying costs to their own costs when they put out their own disclosures. And so some corners of the market, like private equity, for example, with very high costs, it almost becomes impossible to own because you're adding vast amounts to your own product disclosures, and those can be misleading because quite often it looks to the underlying client as though that money's been taken straight out of the client's investment pool. So I think that's a big pushback. But I think generally, probably the biggest, I mean, that's a major issue, but is the so lost my train of thought there. But it's just the massive oversupply. I mean, a lot of these funds were launched to sort the fact that discount rate deposit rates were effectively zero, and there is no demand for those products. So they're very, very cheap, but who's going to own them? There's just so much issuance there. So we need to see the oversupply sorted out to bring share prices back into equilibrium, because an investment trust share price is the balance of supply and demand. And there's an enormous supply out there, and there is some demand, and a lot of these things look quite attractive. But it's going to take a while for buybacks, wind downs, mergers, etc., to get that market back into equilibrium.
Peter, do you think, because it's been talked about quite a lot, do you think the consolidation amongst the wealth managers has actually been a big impact on the demand?
I think it probably has been, James, and it's going to continue. I think for the really big ones, I just don't sense there's been much in the way of demand at all for investment companies in the last, certainly the last year. And I think when you're talking about discounts more generally, I mean, Nick's spot on, oversupply in certain areas, but lack of demand also. And that's caused by a whole variety of things, from interest rates, cost disclosures, but just adverse sentiment towards particularly UK equities, because although you might say, well, it's an emerging market trust or it's a alternative or something, UK equities and how the FTSE is doing definitely colours sentiment for your retail investor on some of the big platforms. And I just think they've not been there. And if you look at flows, certainly in open-ended, but also I think it's there in closed-ended, it's still very negative for UK equities. And I actually notice it, James, I tell you, because the managed portfolio trust has two portfolios, a growth and an income. And it's quite interesting because I've been steadily buying in shares in the growth portfolio, which has performed better in the last year. And I've been issuing shares in the income portfolio. And in fact, I've done it in the same day, buying in one and issuing the other. And I think that says a lot about people just don't have the confidence. And having said that, and I'd be quite interested in what the others think, I think we are in the process of the narrative has kind of bottomed, stabilized, and it may be that it just takes time to flow through to the wider marketplace and the retail marketplace, which translates into buying. Because I think if you think about, back at Christmas time, it was about companies leaving the London Stock Exchange. And as we moved into the first quarter, it then moved into look at the number of mergers, acquisitions, or particularly takeovers. Another one today, Britvic. I mean, and really quite a lot now at all levels, big, medium, and small. And I think the narrative as we've moved into the spring now has come on to the UK market is really cheap, Mr. Private Investor. And, it's something to consider. We're not going into a recession. We look like politics is perhaps not going to be quite as much of an uncertainty. And so consider that and look at the potential returns you get. But irritatingly, I think it takes some time for that to translate through to the average sector discount of 15, or even for equity funds, as you showed, James, it's probably 10 or 11. And that's great value. But for that to start tightening, I think you've got to get the retail investor, because they're the marginal buyer now, really on the front foot. And I don't think we're quite there yet.
Yeah, I think we can't understress the importance of retail investors now to this market, given what we said about the wealth managers. So when thinking about sort of solutions as the sort of next thing, then I'll come back to you again, Ben. What sort of levers do you think that are the best ones to pull for what your fund and maybe for the other Aberdeen funds? What do you think's working?
Yeah, so it's the sort of 64 whatever it is million question, I guess. I think the most important thing, and I guess Dunedin in its own very small way kind of set out to reposition itself about 3 or 4 years ago, and I think it did quite a good job of positioning itself more as a kind of total return, income growth orientated trust, and also with a focus on sustainability that positioned it quite differently within the equity income space. And actually we managed to get a pretty good following. Discount came in quite nicely. And I think it's that combination of a very clear proposition, confidence around the income, confidence around capital returns, etc. That's kind of what you need at a high level. But I think in the current situation, I think again, trying to reiterate those points, I think that the D2C piece is really important, because that's the bit where our shareholder base really has changed hugely over time, and our investor relations activities have changed significantly as well. So if I think about the shareholder base today, we're probably 35-40% on the platforms, and that's sort of growing at a couple of percent a year. So really, that's the sort of private investor is our incremental buyer, and as the guys were saying, it's generally coming out of the wealth managers. Then we're probably a bit small to be in some of their models. So that's the direction of travel, and so our IR efforts have definitely moved to be more targeting, doing events like this and speaking directly to people, and then on the other hand, trying to find the smaller wealth managers, because there's an interesting trend, right? Because as the wealth managers are consolidating, it's also spawning lots of mini wealth managers, right? As people spin off and they don't want to be part of the big firms, and actually they're really attracted to investment trusts because they love the fact they're lower cost, they love the oversight, they love the leverage, they love the discounts. And I think that piece is also quite interesting. So where can we go out there and find some marginal buyers who might not necessarily have the biggest amounts of assets, but can make quite a big difference? So I think our IR efforts really matter. I think being really clear about what we're doing. And then there are the sort of traditional elements around buybacks and so forth. I mean, I'm quite happy to be buying back quite a lot of stock at these levels because I think it's a great deal, right? If we can buy back what I think is a fairly undervalued portfolio in very, very blue chip companies at a 10-11% discount, that's going to be pretty earnings enhancing, and it's going to be value enhancing. So I think that's a nice thing to be doing. I mean, ideally, we don't particularly want to be shrinking the trust from a liquidity perspective and to some degree from a commercial perspective. But I think that's a good opportunity as well. I think though with some of these things, it's all. I mean, you've probably got loads of data on this stuff as well, just. But the correlations between buybacks and yields, and it's not clear that there's a magic bullet, right, for these things. But I do think in terms of what we're doing right now, I think it makes sense.
Yeah, fair enough. Nick, do you think? I mean, we're looking at all the other bits and pieces that are going on. There's lots of M&A going on within the sector. Is that helping?
Yeah, it's helping on one front. I think what individual trusts have to do is to look to the audience that they're actually playing to. So for example, with MyGo, it's high net worth individuals, people splintering away from the major players, as Ben was talking about, and retail. The likes of Bruins for smaller trusts are long gone. They've disappeared. And if you put the stark numbers, and this is oversimplistic, but Rathbones Investec merging 100 billion, you want 1%. That's the move to standardisation. 1% of £100 billion pot is £1 billion. It makes buying Scottish Mortgage difficult on that basis. So I think we've got to accept that for many trusts that ship has flown. But if you're a £100 million trust, you could be getting on quite nicely with the sort of the high net worth individuals, the splinters, the retails. A £250 million trust that's purely got the wealth managers, the big mega chains, have got a problem. So when people talk about small trusts, there's a big difference between a trust that knows its audience and has got a following, and another trust that's purely got the old school mega, the Bruins, the Investecs, the Rathbones. That's a big issue for them. So I think M&A, coming back to your original question, it's one thing, but it needs to be a whole portfolio of things going on, and driven really by the individual trust to recognise where they fit in going forward.
Yeah, I think you're right. And I suppose what we're talking about here is trying to adjust the supply side of the equation. Is there more that we can do? I know Ben's alluded to a bit, but is there more we can do, Peter, to create more demand?
Well, I think marketing and communications is huge for every trust, from Scottish Mortgage downwards. And some have embraced it and are quite successful, and others are still a bit behind where we're at. I may be thinking of sort of more legacy shareholders like Bruins and Rathbones and that, who are not out the sector. They're just not going to be the marginal buyer going forward. So you have to keep them appraised of what's happening. But if you're looking for new buyers, I think it is the retail, and it's not easy to communicate with and get demand there. And also, as Nick was saying, kind of the spin-offs from some of these big organizations who've come about through mergers and what have you, and people break away in Bath and Harrogate and Edinburgh and whatever, and they're running 500 million or 1 billion. Those are the people where investment companies, really that's a fertile area. So that is huge. If you can really, focus on that, obviously deliver decent performance in whatever sector and that they're doing. But I do think share buybacks have been important, James, and in certain sectors too. And I think, for example, private equity, not something you'd have thought about from private equity 2 years ago. And now it's, most of them, some more than others, have really embraced that. It's perhaps harder for other alternatives, but it's certainly something they need to consider. And actually now, if you look at trusts that do buybacks, it's really across the board. And it's not so much to close discounts, it's more just to try and address this supply-demand imbalance, which we see. So I think that's, certainly. So buybacks, yes, definitely. And I think always better marketing and communication and more of it. And I think along with the general macro of hopefully let's see the UK market perform a bit, and maybe we might begin to get on the front foot here.
Cool. Okay, let's get to some questions then. So I do want to run through some questions here. I want to talk to you about your portfolios as well and how that's reflected. So the first question that's on here is an easy one. So the charts that I put up did not include 3i to answer the question that's there. 3i is always at pains to say it's not an investment company, although most people do include it in there. We don't, so it does not include that. And then there's a question here: so what's the split between wealth investors and self-investors? I think the last stats I saw, it's about 2/3, 1/3, but I think it depends which part of the market you're in. Actually, Ben, do you know what it is for your fund?
Yeah, I think it's about just under 40%. I think
40% is wealth managers, and yeah.
Within
those wealth managers are some of the ones that we're talking about that we like, the sort of ones that won't sell. Is that true?
Yes, yeah. So we don't have a massive stakes from the big wealth managers. I think that they affect the other things they have are sort of constraints around things like capital gains tax. So they might not necessarily change people who are invested in certain funds, but they're not adding incrementally to that. And as I guess life events happen, then eventually those holdings get sold down. But that's just been a feature of the last 10 or 15 years probably.
Yeah, exactly. And Nick, what about your fund? Who are the shareholders of that?
Well, again, platforms are probably sort of 40-45%, steadily creeping up, like probably pretty well every other trust. We've probably still got about 10% in the old big cap wealth managers. Often they might have bought at launch. Some of those stakes have been bought 20 years ago. And quite a few high net worth individuals in there where we know who the individual is. A lot of people that own MyGo have worked in the industry. So it tends to be quite knowledgeable about the trust sector. And there are occasions where we're updating shareholders and you want to wonder whether to ask for their autograph rather than just give them a presentation, but which can be a bit scary. But so there's a bit of a mix. I mean, I think the main buyers we have at the moment are people splintering away from the wealth managers, people who would have been working in a large office in a city centre, now probably working out of a barn conversion and taking their dogs to work and running less money, but a much better quality of life.
Next question on here is something that's always been sort of a thing of ours. It's and maybe I'm going to ask Peter. Do you think that all funds should charge fees based on their market cap rather than their NAV?
I think yes, actually. I think that would be quite a good idea. It'd be tough going for certain sectors, but it's possibly, I mean, already some do. and that's encouraging. I think it's harder for some of the, how can I put it, sectors which invest in illiquid assets, where you kind of feel there's always going to be some sort of discount. But nonetheless, it's something that would truly align interests with shareholders. So I suspect it's not going to happen overnight, but it will happen gradually. And it's something where, I mean, my feeling is, what should equity funds, liquid equity trust, what should Ben's fund trade at? It probably should be somewhere between par and maybe a 5 discount. So, and other things like what's the sentiment in the market might determine that. And so therefore, it's not going to be a huge issue for him, but some private equity trusts, property, what have you, might be harder. But I do think it's something to consider, and I do think it will be a trend that we will see steadily, but it will take a while.
Okay, thank you. Should funds be more aggressive about their buybacks? There's a question here. Scottish Mortgage did £1 billion worth, or promised £1 billion worth. Nick.
The circumstances of most trusts are completely different. I mean, what we do, and it takes a while for the market to buy into it, is that we do issue and we do redeem. So we trade on about a 1.5% discount, but that's because the market knows how we behave. And if we get stock building up in the market, we get it out of the market before it starts having an effect on the discount and on the share price. And once the market's got used to that's how you behave, you don't have to do that many buybacks, because they know you're there in the market, and if they wanted an exit, they could get it. It's very different if you're a very large fund where there isn't a lot of demand. You must feel sometimes you're just shrinking the fund, and getting a modest rack up in the NAV. So I think it's horses for courses. What works for us may not work for a big generalist trust, for example.
Fair enough. Do we think that tenders, as opposed to buybacks, actually help? So if I do a 25% tender versus where if I do buy back 25% of the shares in the market, would I get a different result? I don't know who wants to answer that. Any one of you jump in.
Well, I think it's an interesting one. I mean, I'm on the board of a trust which has just done that. It said it was going to have this is the Odyssean Investment Trust, and it said it was going to do that in its 7th year since listing. It's performed quite well, as it turned out. There was no, there's a very tiny amount tendered, and that was more than taken up by natural demand. But there are other trusts, and I think I view things like annual redemption. Sounds a good idea, can be a good idea, but I think sometimes it does work against the trust. And so I had a session with Gervais Williams, who runs Diverse Income, and there's a case in point. The UK has been out of favour. He's in mid and small caps, doubly out of favour. And every year they have an annual redemption. Does it make any difference to discount? I don't really think it does. And all that's happened is the trust has shrunk. And I mean, I said to him, if you get, 25% tendered, a few weeks ago, if that happened again next year, you really are materially reducing the potential marketability of the trust. So what do you do? So I'm quite interested, for example, Baillie Gifford UK Growth, and there are other trusts too, and they have got some similar. It's a wide discount, 15, 17, not performed that well, and they've got a sort of 5-year performance-related tender, and I think there is some mileage in that. You've got to watch how you structure it, but it gives it some time to hopefully perform and outperform, which is what you want, without necessarily just getting, because I think it sounds great to say, oh, we're going to take you out at NAV, but it doesn't really do much for the discount for most of the year. And you can get some of the wrong people on the share register who buy in at a 9 and get out at a NAV less cost. So I think it's also, you have to analyse each trust differently in the sector they're in. But But that's something to consider.
I think
Ben,
as an investor
sorry,
in
sorry,
the as an investor in the sector, sometimes with tenders and how they're structured, you're forced out. You know, if you're sitting there, the trust tends to trade at a 10, and then you got an exit at 2. Even though you might love the trust, you are forced to sell. And I think, you know, diverse income, which was Peter was talking about, Gervais Williams Fund, is a case in point. They just have the one mechanism, which will have an effect a month or two before it happens each year, but nothing's being done in between. So we have one of those. It's every 3 years, but the real work is done at the coalface. And if, you know, if this week we've got more sellers and buyers, and you know the market is now getting up to the maximum it's happy to take, you know the share price is going to start falling, so you step in and do the buyback then. And it's that heavy lifting in the short term that has the much bigger effect than the one chance to get out every 3 years. But of course, if you have that, we don't get the big exit every 3 years. Well, we haven't on the 2 occasions it's happened. We've had sort of less than 1% come out, and even then it's people ticking the wrong box, because they know they can sell in the market. They know there's an exit there, and therefore, you know, if they want out, they're already out before we get to the 3-year tender. So you need a portfolio of mechanisms, really. And the law of unintended consequences, we see it so many times that it's in a boardroom it makes a lot of sense, but you know, in the sharp end, you've turned a lot of your fans into false sellers, which is not what you originally wanted to do.
Yeah, I do wonder that. But like I was talking about discontinuation votes earlier on, like, you know, the wording of a resolution that way, you always get people to tick the wrong box. It's just daft anyway.
Yeah.
Ben, do you think the previous comment that your fund should trade between sort of par and 5% is about right? Is that what you agree with?
I mean, I think that kind of makes logical sense, right? You know, you could probably sell the whole portfolio tomorrow, apart from maybe one holding, in like 10 minutes. So, you know, your ability to liquidate it and turn it into cash is there. So I think that does make sense. And I think, you know, traditionally those trusts have traded in that sort of range. I think we've had a bit of an issue where we've changed our share plan ownership over, and as a result, that's basically put more stock back into the market, because we've given people the option, reminded them that they've had these shares they might have forgotten about, and you know, in the current environment, people have taken the decision to sell. So we've had a bit more supply coming into the market, which I think is probably the reason why we've pushed out an extra, I don't know, 5 points or something on that. That should equalize itself out, and I think it's that point Nick was making, where I think, you know, if we're smart about it, we can probably kind of calibrate, well, what do we need to make up in terms of demand from the buyback to offset the flow that's coming back into the market. And actually that's kind of okay, because, you know, buying at these prices is and there's a piece for me where, on the one hand, yes, it would be quite nice to trade at a premium, and it'd be quite nice to issue stock and grow. But equally, as an investor, I quite like buying shares back at a discount. That kind of appeals to my kind of investing piece. So there's a sort of, you know, an element to both of those things. And I think the flexibility around the buyback, I do think is preferable to, you know, fixed point tenders. I mean, we used to invest in a real estate company, which in lieu of a dividend used to just buy back. I think 2 or 3% of its shares every year, but at a big premium to the share price. And over the years, that generated a huge amount of NAV accretion, because even though it was, you know, shareholders were happy because they got out a premium to the share price if they wanted to, and they were happy because they were buying stock in at a, you know, really big discount to the company. And I think, you know, you can have some things like that that can work quite well sometimes, but the discount we're on is in that kind of order.
There's a couple of dissenters here in the questions saying, "Are discounts a problem at all? Like, isn't it just a great thing that we should, you know, we shouldn't try and tackle them, keep the fund the same size, and they're just an opportunity for people to buy in cheap?" What do you think about that, Peter?
Yep, I mean, that's a view. I think that it also means you're probably going to end up selling cheaply if a discount becomes ingrained and it's always 15 or 20 or whatever that may be. And so I think I don't wholly agree with that. I think it would be better in a perfect world if, you know, liquid equity funds traded round about par. That's probably unlikely. In certain times it does happen. The UK equity income sector did that for quite a number of years. But I think just to say only discounts, it's great when you buy in at a 30 discount. And Nick will know much more about discounts than me, but he probably doesn't want to have to sell it at 30 discount as well. He'd like to see it, come in quite materially, maybe towards par. And so if you just completely ignore the discounts, I mean, there's other things, macro events, how well the NAVs performed, all this sort of thing will have an impact on discounts both ways. But I think managers have got a certain tools they can use, and things like buybacks, marketing, communicate, all of that can have quite a different or an impact on discounts. And I always like to see managers trying to do their best to close the discount. First way is super performance, but then some of the other things we've mentioned can also help. So I'm probably not fully in agreement with just leave the discounts alone.
Yeah, I think that the board and the manager have got to appear to care about the discount. It doesn't have to be a particular level. At least they care. At least they know what the discount is, and they're just not letting it languish. And I think also on Peter's point, there does need to be a catalyst. If you're buying into a deep discount, you've got to see why that might change, because we can think of plenty of trusts where that's never going to change, particularly the family-controlled ones.
Yeah, fair enough.
Yeah.
We mentioned cost disclosures earlier. The question here just asking what happened to the House of Lords effort to address this issue. I think I know the answer to that. And basically, it's gone. I think when they called the election when they did, it was just about to be presented to the House of Commons, and I think we missed the chance now. It's back to square one, unfortunately. Which is there we go. But it's only one element of what we're talking about here, and it's an optical thing rather than a real thing, which is the thing to stress, I suppose. Right. Okay. Now, what I wanted to get to really is opportunities in all of this. So maybe Peter first. Why don't you start off with
well, I'm glad
things in your portfolio that you've been able to buy cheaply.
Yeah, I've got it here. I'll get the
Cool.
I tell you, very interesting. Yesterday, I attended quite a big conference in Edinburgh that Winterfloods, the stockbrokers, ran. And they do it every summer. And what was interesting was this was the biggest attendance they'd ever had. There was well over 100, which kind of is unusual. Maybe you get that in London, but in Edinburgh, had a great series of speakers. And I thought the two best ones were Marcus Fairmudge on TR Property, and also Laura Fall was talking about Lowland Law Debenture and Henderson Opportunities. It could have been Ben Ritchie talking about digital Dunedin income growth. And I think what came across here was how, a lot of things are lining up now, I think, for UK equities in a relative sense. By that, I mean, versus Europe, America, all the rest of it, to actually do quite well. And valuations are low in lots of areas. In the case of property too, you've had quite a massive sell-off. And I think, I now take the view where actually I'm quite happy to outsource property investing to Marcus, who is right on it. And there are lots of opportunities there, both here and in Europe. And I think you get some pretty special performance there. But the other thing, last year, when they had that conference, the sentiment was just awful. And that's amongst other wealth managers and individuals who attended. It was really negative. This year, it wasn't. It was very much on the front foot. And lots of it, there was a private equity discussion. Chairman of Pantheon was there talking about buybacks and the likes, and RIT Cap. RIT Capital bothering to come to Edinburgh, do a presentation. Discount 31. Over to you, Nick Greenwood. That is an interesting one. It's not going to change overnight, but 31 discount. Well, I don't think it's going to go to 40. And they have bought in lots of shares. So I feel much more, and given where discounts are, James, I think if you take a medium-term view, i.e. not the next quarter, but maybe the next year or two, I think investment companies generally, and particularly UK ones, you might get some really good performance there. And so it's an area I'm trying to emphasize in my portfolios.
Cool. And Nick, what about you?
Well, I think it's like, you know, kids in a chocolate shop at the moment. I mean, there's just so many opportunities around. You don't even get out of bed for a 30 discount now in the alternative space, and that's why RIT is out there, you know, because but there's a fantastic arbitrage, because as we said before, the lack of demand is for the structures. A lot of these structures were put in place when, you know, deposit rates are effectively zero. So there's an arbitrage opportunity here, in that, you know, there is in many cases plenty of demand for the underlying assets, just not for the vehicle. And, you know, if the stock market can't value something properly for internal reasons, in the end, the real world comes and takes those assets, which is what we're going to see in small and micro caps as well, which is in this, you know, suffering in the same way as investment trusts. So, you know, looking at things that trading out on big discounts, Corgent had some great numbers yesterday. Of course, trades on a very wide discount because it's in the alternative space, and also because people see it as similar to DG9, which had awful problems. But, you know, DG9 to me seems that the people involved are financial people, where some of the people at Corgent, I can imagine them shinning up a telecom tower with a screwdriver. You know, they live and breathe their own industry, and that difference will sort itself out. Tufton, you know, I mean, you know, basically ESG means that boats have got to go slower and slower, but all the shipyards are already full. So effectively, that's capacity being taken out. Yet, you know, the thing trades on a very wide discount and will start handing money back, or it's going to orderly wind down in 4 years' time. So, you know, you are going to get over a period the elimination of that discount, and, you know, things like Vietnam opportunities, again, special situation in that, you know, the macro view is that they benefit from what's going on in the China-US trade war. But also there's a stock market legacy from around 2005, when briefly Vietnam was the hottest investment destination on the planet, and led to some insane amounts of money being raised for Vietnamese closed-ended funds. And the legacy of that is that, you know, things like Vail and VOF, the two biggest ones, are FTSE 250 constituents in their own right, which completely dwarfs demand at the moment. But, you know, the board are buying back on a regular basis, so supply is being shrunk. I think our view on Vietnam will become more universally accepted, bringing some demand, and there'll be a tipping point out there, and it won't be on 20, it'll be on a 2. And things that just have never got a following that will probably die, you know, things like Schroeder Bridge Opportunities, which is a great fund, but has often been traded out on a more than a 30-odd discount. And again, there, you know, it's got a fixed life to 2028. So, you know, it may be on a 31 discount today, but in 4 years' time, it won't be. And it's a very well-regarded team. It's just, you know, it's just never been able to get a following because it started off small. So it's just, as I said, it's, you know, kids in a sweet shop, and we're geared for the first time for ages. You know, it's you know, we've got far more buy ideas than sell ideas, so we keep going to the bank and borrowing. Yeah.
And Ben, I mean, I know it's slightly drawing the analogy slightly further, but we've got this situation where the UK is unloved, UK small caps particularly unloved, and mid cap unloved. That's the sort of thing that's in your portfolio, and you're trading at a discount. Is this an opportunity too good to miss?
Yeah, I'm always been quite cynical about the UK discount thing, partly just because of the consistency of the market. So, you know, I think when people get the Union Jack out and start waving it, but in reality, you know, what you really need is the iron ore, copper, oil, and interest rates to go up, right? So doesn't sound very British particularly, but that's the kind of drivers of the market. But I certainly do think that there's lots of good value around in the market, and we actually have just increased our gearing, which last time we did that was in March 2020, just to give you some idea. So we've just increased it by just over 1%. It doesn't sound huge, but it's I think a meaningful a meaningful step, and that's really just driven by the fact that we have more things to buy, a bit like Nick was saying, than we have capital, and that we don't try to have some sort of sophisticated top-down macro view on whether it's the right time to gear the trust. I think we'd all just get confused. But essentially, we just look at it and say, are there good opportunities in the market? And I mean, just as a very simple one, I'd pick out something like National Grid, where we've got a yield of 5.5%. They've just funded themselves for the next 5 or 6 years, probably going to grow that dividend at 5 to 6%. The long-term total return from the grid has been 11 to 12%. Looks like we'll probably get 11 to 12% going forward. And I actually was thinking we should just put the whole portfolio in there, because that actually would be pretty good with a little bit of leverage, and we should deliver a pretty attractive return. So there are things like that out there. I don't think you're going to have to work too hard to deliver market-beating returns over the long term. I mean, Peter referenced real estate. I mean, again, that's a sector that's absolutely on its knees, and you can buy into some really good assets. And I think all you really need to believe is that base rates start to fall over the next couple of years, and some of those things will look really good. I mean, Assura would be a good example of that. It owns effectively GP surgeries and primary care facilities. These are government-backed 25-year leases, inflation-linked. I mean, that's fantastic. Not so great when rates go up, but long term it's going to be pretty good. And there's quite a few things like that around there. And there's a lot of things with really high dividend yields where we actually think they're pretty sustainable. So something like M&G or Chesnara in the closed life space, where you've got back book pensions that are going to be there for the next 50 years, chucking off cash that the company is going to distribute out. So I think there's lots of quite attractive opportunities to make not hundreds of percent, but pretty good long-term market-beating returns without having to work too hard, which is great. And if you can find some more exciting things around the edges, then that's even better. But no, I think it's an interesting time at the moment for sure.
That's good, thank you. So there's one specific question we should probably tackle that I think was Nick. So why should a family-controlled investment trust automatically trade at a discount?
In the case of many trusts, if the shares trade very, very wide, they may all get attacked. If you're trading at sort of a 40 discount, 60 pence in the pound, and a deal takes place at 80, the sellers are happy because they've gone from 60 to 80, which is a big percentage. The buyers have bought assets on a 20% discount, and the natural selection lives on. If the family owns 60%, that market balancing can never happen, and therefore that means that you're unlikely to get any kind of corporate activity which will release the value, and the market then prices that in.
Fair enough. So actually,
we have actually bought into some of those situations. The big difference is when you get generational change.
Yeah. When
the 60-somethings are disappearing, and the 35-year-old next generation come in, may want to do something differently from the previous generation. So there are special situations where we do get involved.
Okay. Well, actually, this brings me on to another question, that sort of a bit slightly wider one, which is if you're looking at trusts on big discounts, and there are some that are on enormous discounts, what are the kind of red flags that you should avoid? Nick?
I can see that one coming my way.
Yeah.
I think basically what you're looking at these big discounts is trying to work out what you think the NAV is, because there are methodologies that make sense in a boardroom when you're putting prospectus together that might make lots of different sense 5-10 years on when the world has changed. What would you actually get for those assets if they were sold? And the answer often is quite different, for better and for worse. But also in the modern generation of the alternatives, you've got a lot of debt there, and we came onto it earlier on. Even if they go into orderly wind down, there's an incentive to keep the NAV as high as it possibly can for as long. So yeah, the red flags all come around the calculation of the NAV to me anyway, and the day job is working out what the NAV really is.
And Peter, is there anything else that you look out for when you're?
Well, Nick touched on it there, but leverage and debt. I mean, if you think of Digital 9, it probably would be still around today if gearing was much lower, and it really was quite high. Then you think of Hypnosis Songs. Again, you know, the guy who was running it just couldn't stop buying yet another catalogue because, you know, they're unique. There's only one of a kind, paying ever higher prices and using quite a lot of debt. And at the end of the day, that and a lot of property problems come from too much debt. So I think just being aware of that is a huge issue on things that could potentially go wrong, where you've got exceedingly wide discounts. And the market often tells you that. I mean, if something's on as wide a discount as it, there may be other reasons. There might be a share structure. So, for example, I mean, one that I'd be interested in, because I bought some shares in Pershing Square, which is the Bill Ackman Trust. It's actually, I think, the second or third biggest investment trust. I think it's in the FTSE 100. He's had a super performance record. And gosh, the thing got out to like a 40 or 50. It's still at quite a wide discount. It's performed extremely strongly. Now, what should the right discount be? Yeah, and you can actually, to Nick's point, because it's a very liquid, obvious portfolio, you know what the value is. So why was the discount quite as wide as it was? And my feeling was, I actually think the NAV will push on quite nicely, but I think the market perhaps was overly pessimistic on Pershing Square. What should the right discount be? I'm not sure, but certainly narrower than where it is. So you have to form your own view in each case. And there, you know, it's not some difficult to value asset. These are big liquid companies on NASDAQ and the S&P, and so it's not difficult. So I felt that was one that was not justified.
I think James is on mute.
There we go. I'm sorry, I put myself on mute. Daft. No, I said fair enough. Actually, I agree with you, Peter. I bought some too, Pershing Square, and it's done all right. That's cool. Yeah, there's actually going the other way. There's a question here about 3i, and I know we just said it's not really an investment company, but it does look like it's trading on a 50% discount, premium rather. Does that put you off? Actually, but let's ask Ben that one, because
well, I think it all really comes down to how you value Action, which is, I think, that basically the largest asset, by far the largest single asset. So I guess that's probably held at some sort of historic price on the balance sheet. It's not a company I know particularly well, and therefore the relationship of market cap to NAV could be very different, particularly because Action's been growing very, very fast, and I guess as a result, the value has also increased quite significantly over time. So I think it is one of those ones where you probably just have to. That's probably not a metric that's going to help guide you too much in terms of making a judgment on it.
fair enough. Generally, though, I always caution people to be wary of big premiums. There's sort of like lots of historic examples. Lindsay Train, for example, where they've just now gone to discount, and you can lose an awful lot of money when you get too excited. Okay. I think we've covered a lot of ground. Actually, just on property here, because we've had a lot of consolidation in the property sector. We've got lots of things that have gone to wind downs. They are aggressively addressing that kind of supply side of the equation. And you had an attempt to launch a new fund the other day, the Special Opportunities REIT thing. I don't know, actually, Nick and Peter, do you actually buy new issues?
I mean, as I have done in the past. There's not been many for quite a number of years. But I spoke to this exact example yesterday with Marcus Fairmudge of TR Props, and they were going to be a cornerstone investor. I think there was a family office putting a lot of money into it, and I think they had, I'm going to say something like 120 million. James, their minimum was 250, and they had a very credible investment team who ran LXI, and Simon Lee, great record. And I thought it's interesting that they didn't get to the 250. And so that tells you what we kicked off actually talking about, the adverse sentiment amongst the key audience for trusts is still there. And also in this case, probably some of the multi-asset funds might have been interested and weren't. And so I think that is just a lesson that although I feel, I think Nick probably is, that we're stabilized. I don't think discounts are going to lurch out much wider, and I feel more optimistic about asset values for a while, but it takes a time. And I would be interested if Special Ops was going to launch, say, by the autumn, would it have made it over the line? We'll not know. But it was certainly a perfectly reasonable idea. And of course, the thing about property, and again, Marcus was emphasizing this to me yesterday, is that now's the time you really want to be raising money and investing, because asset values have come down. There's not been overbuilding, oversupply, and rental growth in now quite a number of areas is becoming evident. But now you can't raise the money because everything's at a big discount. And when you can raise the money is the exact wrong time of the cycle. Things have had 4 or 5 years and everything's at a premium and you pay expensive amounts for assets. So it was the right time investment-wise, but we're not there yet in terms of demand. And I don't know how far out we are from that, but that's it, unfortunately. So Special Opportunities back on the shelf.
Yeah, but I think it speaks to the whole thing we've been talking about here, is that you've got this kid in the candy shop situation that Nick was talking about. We just need to get people to take advantage of it. So hopefully we've convinced some people this morning that that's the case. So thank you very much, everybody. That was really useful. I think we've reached the end of our allotted time. I think it's down to me to share the legal disclaimer side, otherwise we'll get in trouble. So thank you very much indeed for tuning in, and thank you for all of my guests. We will be back next week, and we're talking to Nick Train, who's another interesting one, I think, that just had a bit of a roller coaster, but maybe is turning a corner. We'll have to wait and see with Hargreaves Lansdowne bid. So thank you very much, everybody, and have a good weekend, and we'll see you next Friday.